Hey everyone, I want to thank you for attending the Place Your Trades Network Spaces to discuss global energy markets. The Spaces is brought to you by Tradeovate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can also trade these on the DOM on Tradeovate's new main platform as well. They're a great way to get exposure to the futures markets with limited risk. You can use the link in my Twitter stream to get the Tradeovate app for free. I also write a weekly blog and daily pre-market overview on the markets in general that you can subscribe to at placeyourtrades.com. Yay, Ellen made it up.
Hi.
I'll be doing a summary of this episode with my key takeaways that will be available to download as a PDF. I just posted that on my Twitter handle. I'll put that in the nest as well. You can just click on that and sign up for it to get it directly into your email to your inbox. Or you can go to placeyourtrades.com/spaces to sign up for it. And now to introduce our guest. First we have Joe. Can you mute yourself? Sorry. I was just getting some feedback. So first we have Joe McMonigle. Joe is the 5th Secretary General of the International Energy Forum, the largest international organization of energy ministers based in the diplomatic quarter in Riyadh in Saudi Arabia. He has over 20 years experience working on energy issues in the public and private sectors. He served as Chief of Staff at the U.S. Department of Energy during the first term of the Bush administration, helping to manage the cabinet agency with a $23 million budget and over 100,000 federal and contract employees. In addition, he served 2 years as Vice Chairman and U.S. Representative to the IEA, an international organization of OECD energy consuming countries, and the U.S. co-chair of the U.S.-China Energy Working Group. Prior to becoming Secretary General, Joe was the president and co-founder of the Abraham Group, a leading international energy sector management consulting firm based in D.C., as well as senior analyst for hedge risk management in Connecticut. Joe is also an attorney and a member of the Energy Bar Association and licensed in DC and Pennsylvania. He also has an FAA licensed pilot with instrument rating, so we know he likes to fly. Next, we have Ellen Wald. Dr. Ellen Wald is a historian, policy expert, and business consultant. She began transversal consulting after years of providing independent analysis to energy leaders. At the core of her effort lies the belief that clients need facts and realistic analysis provided by true experts via exceptional communication. She is also the author of Saudi Inc., The Arabian Kingdom's Pursuit of Profit and Power, a book on the history and strategy of Aramco in Saudi Arabia. She's a foremost expert on Aramco strategy and motivations and has met with numerous top, current, and former executives of the firm. And she's secretly sought after for her expertise on the company. I actually have the book. It's very good. You should get it. Dr. Wald. Energy, industry, and geopolitical analysis are read by tens of thousands each week. She writes a column on geopolitics and energy markets at investing.com. She also provides frequent analysis for Bloomberg, New York Times, Washington Post, The Modern Trader magazine, and history and policy journals. She's a graduate of Princeton University with a bachelor's in history and Near East studies, and has her PhD from Boston University and energy history, foreign policy, and the Middle East. She's taught international relations, Middle East history, and policy for a decade. Very esteemed panel we have here today. So I want to thank you both for taking time out of your busy days to be with us. And with that, we will go ahead and start with the questions. And we do this in a round. I think you both have been on the spaces before. So we'll start with Joe. First, well, the burning question, obviously everybody wants to know right now, is Saudi Arabia going to extend the voluntary 1 million barrel per day cut beyond August? If so, when do you expect them to make a decision on that?
Well, it's great to be with you, Tracy, and great to be with my friend Ellen again as well. I haven't talked to you in a long time, so great to join you again. Well, I don't have any inside information. I should sort of caution everybody, but I gave I think it was CNBC or Bloomberg interview last week in which I said I expected that they will extend, and I think the decision is likely this week because the Aramco sets their prices early this week. So I expect it to be made any day now. And my thinking here is really not much has changed in terms of the sort of the recession narrative that's really weighing, or until recently has been weighing on prices, and so I think they're going to really just want to wait and see, give it another month to see if this current rise in prices is something that's of a longer duration or some kind of market short term thing. But I think as maybe we talked about on a chat, I've been thinking that the April OPEC cuts are really just starting to impact now, and you haven't really even seen the first 2 months of the Saudi voluntary cuts. And so I expect we're just entering, what is going to be, I think, the next couple of weeks and months of, I think, massive inventory draws. Maybe we saw that starting today, but the second half of the year, I think we're going to see, I think, very tight markets, and I think the Saudi minister kind of indicated or signaled in a previous interview that basically pointed out the last time they did voluntary cuts, it was for a 3-month period. So I think it all adds up to another extension that will probably be announced this week. But again, I want to caution everybody. I don't have any inside information.
And then I have to ask, because this just happened. So, what do you think this Fitch downgrade, if anything, means for the oil markets? Because people are talking about this is what's going to send us into some credit events that's going to set off a global recession. So, do you have any thoughts on that?
Yeah, I mean, look, I think overall my 30,000 foot view here is that in the commodities sector, the narrative weighing on the market is basically we're going to be hitting a recession, and therefore you expect lower demand for not just oil but all commodities in general. And that's quite different, I think, from the equity side, where the macro market is pricing in a soft landing, and so so there's a disconnect between these two macro markets. I think with the paper markets on the commodity side, especially in the oil sector, is kind of waiting for some hard data that that we're not going to, that demand is picking up essentially, and I think you're going to start seeing that now in inventory draws. And but there's been a lot of moves over the first half of this year from OPEC and other sort of geopolitical events that normally you would have seen, I think, prices react to. But because of this recession narrative, it hasn't really. But I think that's changing. And I'm not sure the Fitch rating, I mean, I don't want to get out of my wheelhouse here because I'm not an expert, but I don't think it really impacts the market expectations in terms of a recession. But I'll leave that to you, Tracy, and others who are probably listening that know more about it than I do.
Well, thank you. I do respect your opinion. That's what I wanted to know. So we'll go over to Ellen right now, and we'll come back to Joe, of course. So I want to talk a little bit about we're going to talk a little bit about these net zero goals, right? Because we love these. So first, how do we get to these electrification net zero goals in Europe and the US without proper infrastructure, being that nobody seems to really want to pay for all of that?
That's such a great question. There are two answers to that. The short answer is we don't. Basically, the whole idea also that electrification equals net zero is just a complete fallacy. Just because you don't see emissions happening at the point of usage doesn't mean that they're not happening. It's like if you buy an electric vehicle, but you charge it and from, in a place where the power that's being provided to it is being provided for mostly burning coal, well, then maybe you're not seeing your tailpipe emissions, but there are plenty of emissions coming from that coal plant, and your car is basically running on coal as opposed to oil. So I think that the whole idea of electrification as this like panacea of net zero is a huge fallacy. And not only that, but the goal of electrifying everything is just ridiculous when you think about the efficiency of different things. So there's this idea in people's minds that somehow like heat pumps are now super efficient ways of providing heat to homes. Well, heat pumps are great in climates where you don't need a lot of heating, like say the coldest temperature you might get is like 40 degrees or occasionally go down to 35, like in the southern US. But New England or upstate New York, you're not going to achieve the kind of heating you really need. Even with the very expensive types of heat pumps, you really do still need secondary sources of heating to really heat your home. So the idea that you can suddenly just do this and people will have adequate heating is wrong. Either people have to accept the fact that their homes are just going to be colder, or they have to accept the fact that they can't totally go to electric. It's just not an efficient use of power. But I love the term net zero because when you put the net in front of it, it really just means that you can just buy carbon credits to offset it and say you're at net zero. So I think that if they want to achieve their net zero goals, there's going to be a lot of carbon credit purchasing going on because that's really the only way that you're even going to come close with today's infrastructure limitations, with the financial limitations, and also with the technological limitations. Just because we've made so many advances, say in battery life in cars or in with other technologies, doesn't mean that we're going to get to the point where these things can just replace natural gas heating. The idea that you can create policy that tries to implement these things before you actually have the technology, putting the policy ahead of the technology is you're going to end up in a situation where the technology doesn't necessarily rise to meet those goals and people are going to be cold.
And people are going to be cold. I like that. So do you think perhaps maybe we are seeing kind of a shift away from this like hardcore ESG rhetoric narrative now that we've seen like Vanguard leaving the Net Zero Banking Alliance and the Net Zero Insurance Alliance has all been disbanded, and just had BlackRock just named the CEO of Aramco to its board? Does that give us any glimmer of hope?
That's a good question. I think that the most important thing to remember is that places like Vanguard and BlackRock, their primary goal is not net zero. Their primary goal is to make money for themselves. Putting the CEO of Aramco on their board, probably a good idea because Aramco makes a lot of money. Like Aramco makes, I don't know what kind of words I'm allowed to use on this, but they make a crap ton of money. And BlackRock is also financing some of they have invested in a lot of their pipeline projects. So BlackRock, I think it's a good assessment of where the money is to be made. So if BlackRock's goal is to make money, then I think they're doing the right thing. Now, for a long time, ESG was a great way to make money because they can basically package these funds and sell them to clients as a way to feel good about investing their money. And that was a huge thing. This was a time when a lot of people were, getting into 401ks and they had to manage their money. And they're like, oh, well, the stock market is evil. But if I invest in ESG, then I feel better about my money. So it's a way to capitalize on people's feelings and to get them to invest their money with particular institutions that also charge more for ESG investing. Now, there was this idea that these ESG funds outperform other funds. And one of the reasons that data seemed to show that was because there was so much money that was pouring into these funds. So they were just getting more and more money from people because they were like a new thing that was being sold, a new, product. And so that's one of the reasons why they looked so good. And also, a lot of the things that they were heavily invested in happened to be doing well at that time. One of the things that we have seen about excuse me, that we have noticed about ESG ratings is that so the ratings agencies are totally like unpoliced. I'm not policed, but they're unregulated. So there are a bunch of different ratings agencies, and they all have their different ways of doing it. But in general, what has been shown is that companies get better ESG scores if they're larger companies as opposed to smaller companies, and for the more information they disclose. So it doesn't mean that they necessarily are like not big polluters or whatnot. It's just about the information that they disclose. So if they disclose a lot of information, then they can get a good rating. And I've looked into some of these things. It's insanely complicated to rate them. I mean, they must have an army of people whose full-time job it is to do these ESG ratings. So, but in general, that's what it shows. But there's the number of companies that people are investing in ESG funds is much smaller. So they're not so well diversified. It's a very small number. But with all this new money pouring in, things were doing well. But I think we have kind of reached the limit of that. That time is now over, and people are realizing like, hey, there isn't anything that's so much better about these funds. They're not necessarily, outperforming. It's just that they were getting more and more money. And so I think that BlackRock, realizes, and I think that they always realize that there's money to be made in energy. For example, they never really divested fully from coal when they said they would. The language that they talked about was very specific language. So there were, index funds that they had that were still very much invested in coal all over the world. It's just that certain types of managed funds were not necessarily directly investing in coal. So you've got to like watch that, and figure out what they're really doing as opposed to what they're saying. But, I would just wait, because in another 2 years or a few years, there's going to come up a new product that claims to, be the new thing. Like, I don't know, maybe they'll talk about sustainable finance or something like that, where you can somehow finance these projects. And it's all just because, things are new and they can sell this product and they can charge more for it. So I don't know what the next big thing is. Maybe it'll have to do with AI. That's the big buzzword now, but there's going to be something new for these funds to make money off of.
With sustainable AI, you can fire all your workers.
Fire all your workers. Use it to pick your stocks. At this point, I'm skeptical about AI, but I'm skeptical about just about everything.
I hear you. I am too. All right, so we'll go back to Joe. Joe, I want to kind of ask. I want to get back into kind of the global markets and how are higher interest rates, if any, kind of affecting global energy markets in both oil, gas, and renewables? Because we know that companies count on lines of credit to, say, buy and store commodities. So are we seeing this affect these companies at this point? And if not, will it?
Well, I think it's hard to say now whether it's impacting them, but certainly if credit is more expensive and or harder to get, I think that will definitely have an impact. In terms of inflation, yes, it's definitely raising costs. I mean, one of the things we track at the IEF, and we do a report every year on investment in the hydrocarbon sector, because as I'm sure you and a lot of your listeners here know, you have to keep investing just to keep production levels constant, let alone growing it to meet future demands. And we estimate, unlike the previous couple years, especially during COVID, when CapEx was down. It's risen a little bit this year, but it's not because there were more wells. It's just because the costs and expenses have gone up. So I'm not sure it's really changed the dynamic, and certainly the need for more investment in the hydrocarbons space.
Do you think this will affect, like, say, shale more so than, say, offshore?
Yeah, probably. I mean, you're looking at more, I think, smaller independent companies that could be impacted. But again, there's definitely cash flow now, and I think for the sector itself, I think it's not so much credit issues now as it is return on investment and returning money to investors, and that's as I look at the second half of this year, look, first of all, this year alone, the top three consuming countries, the U.S., China, and India, are up 3 million barrels a day versus a year ago. The second half of this year, China and India's demand growth will account for another 2 million barrels a day. So the second half of this year, we're looking at not just tight markets, but definitely a supply demand imbalance, and so this is going to be a serious situation going forward. And I'm not as worried. I think OPEC will adjust, and they'll do what they say they're going to do. The question is, what is non-OPEC supply going to do? And the U.S., yes, the U.S. production has gone up a little bit. Not just a little bit, I think substantially, but it's starting to level off now. And the question is, what happens in other countries, Brazil, Mexico, Colombia, watching what happens in Guyana. So there's a lot, I think, of open questions here. I don't think, OPEC wants to see prices skyrocket here. I know this is contrary to probably conventional wisdom and trader conventional wisdom here, but they really don't. I mean, they've seen what happens to the global market and demand for their products when prices spike, to $130 a barrel, for example. They want to see a healthy global economy that is developing and creates more demand for their products, and so it's a tricky balance to have, and but I think what we've seen over the last 6 months is that they haven't been in control. It's really been this recession narrative. Now, whether the inventory draws now starts to change that, I guess we'll wait and see. Although since I made those comments in India about 10 days ago when we first started talking, we've started to see, I think, prices bump up here into the mid to high 80s, and we're starting to see, I think, some evidence of the inventory draws.
Yeah, and I think we'll definitely see bigger draws, at least in the United States, with China, or at least for August, with China, with all that they have ordered that's taken away from the Middle East. But so we'll have to watch that in the United States. But as far as, since you brought up South America, I just was curious, do you think that the industry is in trouble? I know a lot of people looking on the spaces, I know a lot of people on the spaces are looking at or involved in Ecopetrol and PBR. Do you think those leftist governments, or because they kind of ran on the platform, they wanted to go away from fossil fuels, but we're really not seeing that happen? So you think that was more of just a kind of a campaign issue, or is that something to worry about, additional supply coming off the market?
Well, I don't think we've seen really demonstrative changes in policies, and that happens in every country, including the U.S., where you may talk about one thing during the campaign, but when it comes time to the hard decisions of governing, you have to deal with reality. In a lot of these countries, especially where it's the government has a big stake or even is the de facto owner, the NOC provides a lot of revenue for the government to do other things that they promised during the campaign. So maybe there was promises made on hydrocarbons production or regulations in the hydrocarbon sector, but at the same time they made a lot of other promises in terms of housing and social spending, and the only way to pay for that is to to make sure that the revenues, which in some case in some cases, I wouldn't say in all cases or most cases, but in some cases it's the lion's share of the revenue to the government. And so I think it's that's a reality that I think governments all over the world that are dependent on NOCs or big stakes in hydrocarbon companies have to deal with. And of course, in a country like Colombia, it obviously affects currencies as well, and so that's another factor.
And then one more question before I move back to Ellen. What should we, given that's happening right now in Niger and kind of the geopolitical unrest that's happening there, is there any specific thing we should be watching as far as projects are concerned in the hydrocarbon industry that might be at risk?
Well, without commenting specifically on Niger, I think we have to constantly be watching geopolitical risk. I mean, this whole Russian invasion of Ukraine and the energy impacts to that, strife in other parts of the world, we're seeing a tremendous amount of geopolitical risk, and companies can plan for many different scenarios. Geopolitical risk is something that they can't really plan for, and so and investors as well. I mean, it's a very hard thing to price in, and I'm not talking about things like the Iran deal, which could allow more oil to the market. It's really where supplies are dramatically affected. And so geopolitical risk is, as I think, is going to be a big factor. And I think increasingly, this part of it is a little bit like that whack-a-mole game. Every time you turn around, there's a new crisis, that affects markets and or should affect markets. Because I will add too, this whole recession narrative has kind of mitigated what some of these geopolitical risks would have had, I think, a larger impact on the market, except for that this global recession narrative has still been weighing on markets on the commodity sector.
Recession that hasn't come yet.
Yeah.
So you don't think so? I guess I was specifically asking, do we need to? There's a pipeline through Nigeria, right? So, do you think that's something we need to be watching?
Yes, definitely watch. I mean, I'm not really following it that closely. I don't want to mislead people, but yes, obviously you want to be very careful. Energy infrastructure is increasingly becoming a target to accomplish other goals for rebels or terrorists or governments trying to have other impacts. So definitely energy infrastructure, I think, is a key, is always something to be mindful of.
Excellent, thank you. I didn't mean to put you on the spot specifically about a country. I was just worrying about the pipeline. But I do appreciate that it's your answers, and I agree that risk is always a big problem. And so I'll go back to Ellen really quickly. So I want to ask, we've seen manufacturing kind of slowing down globally, kind of if we look at PMIs, particularly in Europe, but really globally, things have been slowing down. But demand doesn't seem to be subsiding. In fact, diesel prices, even in Europe, are rising in a tightening market. So kind of, do you know what's going on there?
That's a really good question, and part of me wonders whether this is people they feel like prices are good, relatively good right now, given that most of the forecasts for markets are that oil and energy prices are going to go higher. And so I'm wondering if there may be a sense of people are trying to maybe kind of buy now, even if they're not using it, and store for later. I think that we're definitely seeing China doing that. I also wonder if there is a sense of, buy the diesel now because you never know when you could like export it to somewhere else, because there's definitely a big kind of export market going on where, like Saudi Arabia is importing Russian diesel and kind of repackaging it and sending it elsewhere, or they're using it and then there's a new market for their diesel. So I think that things are a little bit out of sorts and out of whack, especially because of the whole Russia situation. And there's a lot of, movement of crude oil and also of products that is not necessarily typical or that we didn't see before, and that could also be kind of skewing some of the numbers. Or they're concerned that we're not going to be able to get diesel later, so we better get it now. Or they're concerned that they're not going to be able to get enough natural gas for the winter, and so they may have to rely on switching to diesel. So I think there are a lot of reasons why we haven't seen that, or we haven't seen the demand hasn't caught up with the fact that manufacturing is slowing. So, we may not see that show up in the demand numbers until, another month or two.
Do you think it could be that markets are looking past that, thinking maybe we're going to have this soft landing and numbers are going to go up again?
I think they could be thinking that the numbers are going to go up again, but but we better have the diesel now because now is good. Prices are better now, and it's going to be really high later. It could be that. It could also be that they're just importing it, and they're gonna, if they don't use it, they'll just export it. They'll just, send it somewhere else that wants it. I think we're seeing a lot of that in China. They're importing as much crude, but they're not necessarily using it all, but they're still processing it, and then they're just selling it elsewhere, or they're sticking it in storage. So I wouldn't be surprised if that's part of the calculation. But at some point, if stocks get too high, then we are going to see lower demand numbers, and that could definitely cause once people start to see those lower demand numbers, that could definitely cause kind of a shock to prices.
And then I kind of want to move to Africa again, or emerging markets in general, but particularly Africa has basically said, the West is going to have to realize we have over 600 million people in poverty, and pushing the West climate agenda on them is unfair. So do you think we're going to see conflict over this, or more conflict over this, particularly in Africa?
So that's a really good question, and one of the people who was always bringing this up was actually Mohammed Barkindo, who has since passed away. But he gave a lot of interviews right at the end of his tenure as OPEC Secretary General, where he talked about how there's incredible energy poverty in Africa, and the best way to get out of poverty there is energy and fossil fuels, and you can't just deny this. And I think that that's something that the world needs to realize. I think that the problem is going to come in terms of financing projects. Now, there's all sorts of corruption and whatnot in all of this stuff anyway, but say you're a country and you want to build a natural gas plant, or you want to build a coal plant or an oil plant, you want to build any of these, fossil fuel plants because you want to supply electricity to your people. And now you've got all of these international, financing organizations that were conceived of with the point of bringing, of being able to finance these projects for developing countries. And, back in the day, you say, Egypt got money to do this, but now an African country can't get money to do this because they have basically said, oh, we're not financing any more fossil fuel projects. So I think that that's where you're going to see a lot of potential conflict, is where the financiers meet the needs of the actual people. That does open up room for other avenues of securing finance that are not, don't come from Western institutions. So we could see China financing these kinds of projects. I wouldn't be surprised if we see that. Now, I don't know what kind of strings that comes with, but it may come with the strings that you got to use Chinese products, or you've got to do Chinese designs. And I think we all know that those projects don't necessarily go as well as otherwise. There are examples in Iran of Chinese equipment just, failing and crashing and falling apart. So I think that there's a risk there for the West in basically unilaterally deciding we're not going to finance these things, when that is really what, African nations need. And in the same way, you're saying to them, well, you say you need this, we say you don't. That's extremely like that. That's like a neo-colonialist attitude in my mind, but apparently that's not what everybody else thinks.
Well, absolutely. And do you think, that also comes down to the question that, right, U.S. doesn't want to be so reliant on, say, China for all of these minerals for renewables. And so they're going to Africa to try to secure these, but at the same time saying, but we won't finance fossil fuels. But we would like the minerals, please.
Of course. Oh, I was going to say, of course, the people who are going to Africa to mine these minerals are Chinese companies, and then the U.S. is buying them through China, which is even worse.
And you saw this, we've seen trips you had, even Yellen go over there recently, right? Trying to strike these deals with Africa. I don't know, does it seem a little too little, too late? You've had China in there for years. You have Russia already established in there. And it doesn't seem like we're offering that much in return.
Yeah, exactly. Yeah, and I think that the better approach, honestly, would be to, instead of trying to get into Africa at this point, is, there are other countries out there that have these minerals and these rare earths, some of which are actually, allies of us, or are in our own hemisphere. Why don't we go there? Why don't we build supply chains for these things with friendly nations and countries that we know are friendly to us? Yeah, it would be great if we could also, go into Africa and build friendships based on, this kind of mining and trade, and also to use better practices. The mines that the Chinese are running there are really generally horrible. I mean, we're talking child labor, slave labor, terrible conditions, terrible for the environment, terrible for the people. It would be great to see, better labor practices put in place, and better environmental practices put in place. But if that's not an option in Africa, then I think it would be good for, say, if Secretary Yellen's able to determine that, say, what, I think this is a lost cause. Let's concentrate our efforts on nations that we know are more friendly to us. Then, that's what they should do, in my mind. That's what I think.
Tracy, I think we lost you, or you're on mute.
Whoops, I'm on mute. I did that again. All right, so I have to say that all over again. Oh, sorry. So why we're talking? Okay, so you're on. So while we're talking about China, so we know that China is the largest global emitter of emissions, right? And, yes, they're building a lot of renewables, but that's really coming from a very low base. And realistically, this is not a very large source of energy for them. They're still, very heavily fossil fuel oriented, coal, natural gas, oil. So, even if they say, even if the West went to zero, it's really not going to matter much as far as climate goals are concerned. So why isn't anybody going after China for this at this point?
Yeah, well, I think Secretary Kerry, as part of the new engagement with China after Secretary Blinken's trip, Yellen went and now Secretary Kerry went maybe about a week ago or 10 days ago, and there was a lot of press attention that there was no big announcement made, but just the fact that they were talking again about climate goals is really important for the very reason that you raise. And so I don't think we can sort of diminish this effort. And also I think the Chinese do want to be seen and engaged in climate discussions and be seen as a responsible government with regard to these goals. But I'd like to maybe come back to your question about Africa too, because we just put out a report at the IF on the Global Energy Solutions Initiative. We basically held a series of dialogues in every part of the world, but we started in Africa. And this theme of a north-south divide was a very strong theme, not just in Africa, but in a lot of other places that we went. And energy transitions have been really around since 1709, but this one is different because we've committed to eliminating CO2 emissions while energy consumption continues to grow, and in just 25 years. And so I think the developments over the last 2 years have demonstrated that the transition is more complicated than was previously thought. We're trying to transform $100 trillion global economy into a decarbonized energy system in just 25 years. And the realization that this is a massive undertaking, I think, is starting to take hold in not just among policymakers, but by business and finance and other sectors as well. And so I think this, expectations of, a linear global transition has really been shaken as climate goals now have to coexist with other priorities like energy security and energy access and affordability, which of course is what's really important in places like Africa. And the emergence of this new north-south divide has really caused increasingly sharp debate over the cost and timing of the transition and its compatibility with other priorities. And there's really, I think, widespread recognition that the path to net zero will have to travel through the global south. And therefore, it's in everybody's interest to collaborate and cooperate on these shared goals. But we saw in Sharm el Sheikh at the COP meeting in Sharm el Sheikh, the global south was very vocal, and that's not going away. That's going to get louder and louder, and I expect there to be a lot of discussion at this COP. The global south just feels they haven't been given due consideration in global climate talks, and developing countries believe that they're not responsible for the climate crisis, and also feel that they should develop their own natural resources, including hydrocarbons, where appropriate to support their economic development. And in many countries of the global south, energy transition means moving from not having energy to having energy, or at least from wood and waste to LPG. So the energy crisis looks very different in Africa and developing countries of Asia and Latin America compared to Europe and the US, where per capita incomes are 40 times higher. So this is a big issue, and it's one I think we have to watch moving forward. And I don't think you know, you know, you know, telling Africa that they just should be prepared for some kind of leapfrog technology that we've seen in sort of the mobile phone sector or other technology sectors is really practical when you're talking about hard infrastructure, when you're talking about energy. And so this is going to be a storyline, I think, for the rest of this year, and I think definitely at COP at the end of this year.
Yeah, and that was you kind of went into my kind of next question, which was, we have, obviously the West, particularly Europe, have set some very high goals to reach net zero. Really, we kind of discussed this as not going to be reached as quickly as we once thought. So, how do we resolve this issue? I mean, is it going to take a change of, tone? Because it seems like so far you have a lot of bureaucrats in power that don't understand this whole situation, right? That don't come from the energy world. So, do you foresee there being some kind of resolve, or, because right now it does it, even the energy crisis that we had, say, summer of 2022, which spooked Europe, a little bit, but that didn't last very long, right? Back to complacence and back to, this is what we've got to do by 2030. This is what we've got to do by 2035, et cetera, et cetera. And so, I just don't know how realistic these goals really are and how malleable these people are going to be about it. Do you have any thoughts on that?
Yeah, well, first let me say now is not the time to grow complacent about energy markets. We can't let energy security priorities ebb and flow with prices. We need to be proactive in implementing energy security strategies, and it's mitigating energy price volatility. I think is crucial for expediting a smooth and just energy transition. And one of the reasons that at the IF we focus on investment in the upstream sector, first of all, we're the organization that has both producer and consuming countries, whereas OPEC is just producing countries for the most part, and IEA countries are mostly consuming countries for the most part. But the reason I focus on it, and some people think it's odd, for the head of an international organization to talk about investment in upstream, it's because if you care about the energy transition, you have to worry about price spikes and volatility. Because if the public starts to connect energy transition with higher prices, we're in big trouble. We're not going to make any progress at all. Now, and in terms of the complacency, I mean, Europe got a little lucky with the weather. Yes, the inventories have been rebuilt, but I think not just this winter, but the next couple winters, we're going to, be on the knife's edge in terms of another crisis. So I think when you talk privately to policymakers, they realize this, but obviously I take your point that the focus has moved back to 2030 goals and the energy transition. But I guess I would point everybody back to this IEA technology report that was recently updated in December. And I think this is really it's a good summary of the whole energy transition challenge, and also a very realistic view from an organization that has really become, an advocate on the vanguard of the energy transition. And essentially what it says is wind and solar and other clean energy like hydro, and I'm not sure if nuclear is included in this, but I think it is, traditional nuclear. That can account for about 50% of meeting our climate goals in 2050. The other 50% has to come from new technologies that are not commercialized or even envisioned yet. So, in this category, we're talking hydrogen, CCUS, direct air capture, fusion, probably new nuclear reactors, or something else. And so until we can, so first of all, wind and solar can't do it all. So anyone who's telling you that is not dealing in real world facts. And and secondly, until we have these alternative technologies, plan B, we have to focus on, making sure that we have enough hydrocarbons to power the world economy and meet rising demand. And so that's the thing. We have to manage the transition, and the answer to the question is these technologies are just not available yet. Now, having said that, I actually have a lot of optimism that these technologies will take hold, and we will, while the energy security priorities may have, sort of set back the speed of the transition, I think ultimately we will get there. And, incidentally, it could be, CCUS plays a larger role. And I think we have to, if you care about climate change, you have to look at this as a emissions transition, not necessarily an energy transition. How do we utilize energy sources more cleanly, I think is kind of the focus.
So really, you would agree with me that we're still going to need hydrocarbons for decades. Or
Yeah.
you don't have to say if you do or not.
Yeah, no, for sure. I mean, even the 2050 net zero calculation has a large role to play for hydrocarbons. And but look, if CCUS and other carbon management technologies could be perfected, that time horizon or the quantities, can change. I mean, obviously, there are some people who purport to care about climate change that don't really care about, they're not focusing on the emissions, which is the problem. They're focusing on the fuel source, and it's more like keep it in the ground. Whereas if you're focusing on the emissions, you want every possible technology solution to be on the table. But there are some people who don't feel that way.
I love it. Well said. And then we'll go to Ellen, and then we'll do the final round. So Ellen, I kind of wanted to ask you, I don't know, maybe you could talk about nuclear. I mean, do you see, obviously the West is not very interested in it. If I put out a list of, all the, new reactors coming online, I would say 99% of it is all in Asia, basically. So do you think we'll see a change of hardware? Because to me, I don't think we get anywhere close to this kind of change without nuclear, right? Again, as Joe brought up, wind and solar definitely can't do it all. So do you think we see maybe a change of heart, particularly maybe with these smaller nuclear reactors?
I think that the small nuclear reactors are a really interesting avenue for energy generation. And I think that there will be some places and some nations that pursue them much more vigorously than others. But I don't see, given like all of the incredible amount of like the regulatory hurdles and everything for nuclear, I just don't see them becoming a big source of power within the next, say decade or more, unless we see some serious regulatory reform. And I just don't see that happening. I think that, if people are really serious about reducing the emissions, then nuclear has to play a role, because like Joe said that, as Joe referenced, like a lot of this stuff has to come from technology that isn't even developed yet. Well, nuclear technology is developed, actually. I'm not necessarily saying that the small modular reactors, but the regular stuff, that is developed. And if we actually started building a lot of nuclear plants right now, we could make a difference in carbon emissions. But that's just not something that people seem prepared to do, both in terms of the national security threat and the environmental threat, and also the, nobody wants to have a nuclear plant in their backyard kind of thing, and the incredible expense that it takes to finance these projects and get them moving in the West. So I'm not particularly optimistic about nuclear, but which is why I think that there really isn't no interest, there really isn't a real interest in reducing carbon emissions. It's more of a lip service thing, or a way to talk about the climate and then just get money for your own like pet projects. Lots of corruption there. Or people really, policymakers really think that that people are going to accept major changes to their lifestyle in terms of not having electricity 24 hours a day, not having the kind of heat or cooling that we're used to, not being able to travel places whenever they want to. So either policymakers think that they're just going to impose massive lifestyle changes on their populations that the populace doesn't realize is coming, or they're not really that serious about this, or they're really delusional and they think that wind and solar can actually provide the energy that we all know that they can't. So it's got to be one of those things, or they don't really care and they're just making policy that they know is going to end up being overturned or extended because it looks good for them now. They get the money now, and hey, in 20 years they're not going to be in politics, so let whoever's in charge deal with the total abject failure and lack of good infrastructure and lack of hydrocarbons.
Well, yeah, I mean, because that kind of leads me to, the IRA Act, and, Europe has kind of their own version of the IRA Act, and there's all this money for kind of all these projects, but mostly it's a lot of subsidies, and it doesn't really address, the regulatory issues we have and the permitting issues that we have, trying to start a mine in the United States, for example. You want to mine here? Yeah, we'll give you, incentive to mine here, but it's going to take you 10 years just to get a permit, right?
Exactly. And there's some degree of permitting reform in the latest fiscal reform act, I think, the one that extended the debt ceiling, but it doesn't really go far enough because it doesn't really manage to eliminate the legal challenges. So even if you can get through they somewhat streamline the environmental review process, you're still going to face mountains of legal challenges, and judges can just put a stay on any construction, as we've seen. So I think that it's a start, but it's not going to actually result in more infrastructure or more, the kind of projects that we actually need. So either we have to decide that, okay, we're just going to continue polluting and that's the way it is. And it doesn't really matter because China pollutes so much more than we do anyway. So, what does it matter if we're still polluting? Or we have to accept that we're just going to have to cut our consumption of energy in such a drastic way that it changes our lifestyles in a profound way, or we're going to actually build a lot of nuclear plants, or we're just going to keep going the way we are until we develop a new technology that is really much more effective than what we have now.
Excellent. All right. Well, we are coming up on the hour. So the final round is kind of your final thoughts. You can talk about something that we haven't gone over yet that you wanted to talk about, or a lot of investors are listening here. What should we as investors really be looking at, say, over the next 12 to 24 months within the sector? And I'll start with Joe.
Well, I'll just follow on what Ellen was talking about. It also, I would say, in the U.S., it's not just regulatory risk on a federal scale, but especially in terms of electrification and renewables, it's state regulations and approving transmission projects to move the energy from one place to another, and that is a very hot political thing that I learned from my time at DOE, and we tried to work on priority corridors, which would give the federal government some type of authority where states couldn't come to an agreement, and passed, but that was subsequently changed. And this is the challenge really for the administration too. I mean, this is not an easy thing to solve. On nuclear, I think we definitely need more nuclear, and anyone who tells you that nuclear isn't for nuclear and says they care about climate change, maybe might just be saying blah 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 because they don't really understand. Nuclear has got, even the IPCC report says nuclear has to play a very important role. The IEA says nuclear has to play an important role. There's lots of talk about how well China is doing in terms of renewables and clean energy, but they're also leading on nuclear energy as well. And I will say that the small modular reactors is actually has a lot of momentum behind it, and of all the different technologies out there, hydrogen and other things that have momentum, this one is actually I think has the most promise. And I have to say, I'm starting to see investors start to look for opportunities to invest in SMRs as well, which frankly the platforms don't really exist yet for that. So that could be maybe an area, for on the investor side to keep an eye on. But the U.S. is doing a lot here, and not just here in the U.S. And there's a handful of companies, private companies that are doing this. But the U.S. government is actually working with the government of Romania to actually that would actually be just another test bed for SMRs, but also to be the distributor of SMR technology in Europe and other parts of the world. So there's a lot going on, I think, in this sector. And as I said, I was surprised to learn recently that the investor community is looking for ways to participate here as well.
Excellent. And Ellen, same question.
Sure. Right now I'm really looking a lot more at the Russia situation and whether or not, this is kind of a short-term thing, but whether or not the price cap policies are really going to be enforced, or whether any of Russia's, current oil trade is going to run afoul of that, and how that might affect global oil flows. I think that also any kind of movement, we're seeing a little bit of movement in terms of Ukraine and kind of these settlement discussions. I think that anytime people see that, there'll be a push to say, assume that things will go back to normal in the oil markets and maybe even gas markets. And I think that it would be wise to kind of take that with a grain of salt, because even if the conflict or the hostilities are ended, it's unlikely that Europe is going to really, or at least a lot of Europe or some countries are going to want to continue or go back to importing Russian energy products. But I think that, this is the area where the geopolitical really intersects with the financial. I think it's important for people who are considering how this is going to impact markets to remember that there are a lot of interests riding on this. And, this Ukraine-Russia conflict is really proven to be a gold mine for certain political and military interests. And so there may be, I've seen very little incentive to actually resolve hostilities. And so, I think that that's an important thing to keep in mind when considering how any kind of resolution of this might impact markets, and whether there actually will be, and in the various interests of the parties at play. I know there was talk about having a kind of summit in Saudi Arabia. Saudi Arabia is a good kind of choice, I think, because they're not necessarily like in Russia's pocket, but they definitely have a good open kind of communication with Russia. So even if Russia's not invited to this, but definitely there's no you can't assume that Russia's not gonna know what's happening. And But remember that Saudi Arabia may also has interests, and they've made a lot of money off of this, situation in terms of the oil sanctions. So my advice to traders and investors is to keep in mind the various interests of the parties, and that they may not be exactly what is being conveyed publicly.
Excellent. I want to again thank you both so much for taking time out of your day to share your thoughts with us. Really appreciate it. I'm sure everybody listening really appreciates it. Again, follow these guys on Twitter. They post really great stuff. And follow Place Your Trades so you can find out what else is going on over there. They've got a lot going on. And again, I just have to thank you both so much for your time. And with that, I guess I will see you guys next Wednesday.